social enterprise is always in my mind. And then social enterprise or social entrepreneurship is broadly understood as a business model that applies entrepreneurial principle to achieve social goals, generating revenue whilst creating measurable benefit for the communities, the environment, or marginalized groups. In Indonesia today, enterprise like Magalarva, which process food waste using insects to reduce fish meal dependency, and Toraja Melo, which support women weavers in Sulawesi, and also Diva Bike. They also organize employment for the disabled motorcyclists, and which provide kind of exemplify this model. And also, if you're talking about the most, or not the most, maybe one of the big corporation which has good ESG, I can say ESG, or basically they have the community program which quite significant in Indonesia. We can recall Paragon Corp as the Misha Isha, and we have Nur Hayati Subakat from Indonesia. And what is maybe less well appreciated that is how deep the historical roots of this tradition run.
The mandates corporate social responsibility, which ideally, the concept of it is not a mandatory thing. It's seen as something that corporations should do to be responsible. But India created this provision in the company's legislation which said that you should invest at least 2%. Companies of a certain size should invest at least 2% of their profits in the last in the 3 preceding years into what the legislation identifies as CSR activities. Now these categories which are called CSR activities are the usual suspects. So environmental impact, community building, gender diversity, nothing strange. Maybe the strange ones are things like Prime Minister's Relief Fund and certain funds that basically contribute. And I think that if you read all of these categories together, it looks like you're asking companies to contribute to nation building in a way. And you're trying to, and this is where probably the global south or a nation perspective comes in, because you're trying to address inequality there. Now, in previous work, I've been a bit critical of this law. Today, I'll talk about maybe what's positive about it. So during COVID, we did see a lot of good contributions from the for-profit private sector into gaps in terms of what the government couldn't address in a country like India. The second part of what I want to talk maybe very quickly is about sustainability investing. While there are, there's investment management funds that mutual funds offer categories of funds called ESG funds. And here again, to address concerns around greenwashing, there's been a number of disclosure rules in India recently for these mutual funds itself. But I think it's interesting to also mention that it's one of the first countries that's come up with regulations around ESG rating providers to ensure that you're getting this, the accuracy of the rating again to prevent greenwashing. And it addresses things like who's really paying for these providers, like you spoke of consultants, right? So there's a lot of conflicts there if you're being paid by the people you're supposed to rate. So there's language around what they should do. Now these regulations are very new, so I'm not saying that they've worked perfectly, but that's my 5-minute preview into this.
Thank you, Akshaya, for the 5 minutes presentation. It's basically still 3 minutes presentation. Okay, next one is going to be Andrew, please.
Okay, thank you. Good afternoon. I will talk about what is the sustainable development plan in Taiwan and how Taiwanese company is making good to the society. So I will, split into 3 parts. The first one is compliance. So we talked about compliance is just the bottom line. It's not the ceiling. Okay, so we have been talking about greenwashing in the past couple of years. See whether if there contains misrepresentation in the sustainability report, there will be greenwashing and there will be criminal liability and so on. Now we still talk about greenwashing, but we talk about greenwashing in different way. So compliance, now we are requiring the company to disclose sustainability related financial information in the annual report. So maybe just like the UK model. So beginning from 2027, the listed companies, they need to disclose the 2026 annual report containing a special chapter in the annual report. That is the complying with the IFRS sustainability standards. So this is one. So in addition to this, we also have sustainability report that is required by Taiwan Stock Exchange, complying with the GRI standards. So there are 2 reports contemporaneously company need to disclose. This is the first thing. So if the annual report has some significant misrepresentation, there will be securities law, civil and criminal liabilities. So this is tremendous. And so second part is talking about how companies in Taiwan perform, how they impact the society. So I will bring up one thing is the Taiwan's financial industry. So particularly we have 5 financial institutions ranked on the top 1% of the sustainability ranking according to S&P sustainability ranking. This is the first one, and we have 2 other financial institutions ranked in the top 5%. So I will give 2 examples. One is the top financial institutions, Isan Financial Holding. They have two things. One is they have invested tremendous amount of money and human resource in helping the partners. So this is going to be the SDG 17, Goal 17 partnership. So they help their clients, more than 3,000 small and medium enterprises, to comply with how to reduce the emissions. Okay, so they help them to meet with those requirements, so they can provide their goods and their service, and also they can export to for example, like Europe. They have a high requirement. So this is one thing. And the other thing is sustainable financing or green financing. Isan Bank also, providing lower interest rate to many partners or many clients if they can prove that they have actually lowered the carbon production. So this is one thing that the financial institution is doing the direct impact on the society. The other bank is Taisin Bank, Taisin Financial Holdings is also very important. They are doing 2 things. One is SDG 12, which is responsible consumption, and the other one is SDG goals number 5, is gender equality. So from the Taisin financial institutions' internal policy, all the employees female employee and male employee, they have the same pay, parity. So now they do the same work and they get the same salary. So this is one thing, and they also have the flexible working hours, particularly for those employee who is providing the caregivers. So now they do this, and they found this is going to provide much higher performance to the company. So, and the other one thing is talking about the responsible consumption. So they have a program. So by digital banking, so all consumers. So Taishin Bank is one of the financial institutions with the most digital banking accounts with retail consumers. So without issuing the paper statements. So this is one thing, and the other thing is that every penny spent by the consumers, they can get green credits, and they can exchange for some sustainable products, green products, and so on. So these are two examples. So in addition to this, so whether sustainable roadmap can actually be implemented is by the third part is the ranking. So we used to have the corporate governance ranking, but now beginning from this year, the ranking system was upgraded to ESG ranking system by Taiwan Stock Exchange. So they changed all the formats and looking into not only just the performance, the corporate governance, but also the E and S and G aspects. So now Taiwanese company, in addition to disclosing what they had done in the ESG aspects, this is not just the competition, but it's real. It's for real. The company need to prove that they have the actual value delivered to the society. So ranking system is one of the most important things that I would think it actually improve, because it makes all of the listed companies disclosure is going to be transparent. And so which company is doing good, which company is doing bad. So this will be my summary to Taiwan's company, how company perform to impact the society.
For example, the SEC, they have withdrawn their plan for sustainability disclosure recently. And also, if you look at the EU, which was the frontier, the front runner of all this discussion, they are slowing down as well. They have announced what they call the omnibus package, which kind of like slowing down the regulatory procedures and also the scope of the company who is subject to disclosure and things like that. So that's what's happening, and in some way we can understand this dramatic change from hot discussion interest in ESG and then maybe cooling down about the interest about the social impact of companies, things like that, because there were geopolitical changes during those periods. Maybe the economy has become more volatile, so some company need to survive in this tough market. So maybe they were more short-term than long-term in some way. So we can understand this change. So now we are in 2026. So the question that I have is that, does this mean that the role of corporation in generating social impact is diminishing? Of course, the answer is not. Maybe there are some changes about the view, but I think that the discussion is evolving into a more concrete and legally grounded forms after many years of discussion about this issue. And I wanna point out maybe 3 issues, maybe 1 international and maybe 2 very Korean. So the first topic is disclosure. So I think already Andrew told about what's happening in Taiwan, also in India, and I see that many jurisdictions in Asia have some kind of sustainability disclosure mechanisms. Maybe the starting year are a little bit different, but they are generally based on the ISSB, International Sustainability Standard Board, which is global, and we can compare from companies to company, from jurisdiction to jurisdiction, because we have same standard, which is a good. So requiring the company to make a disclosure does not mean that you want the company to follow a certain directions. But what you want is that you disclose what you are doing, so that maybe shareholders, investors, and stakeholders, they can know what's happening, and there are various ways that they can make some influence about the direction of the company. So, for example, you can vote, you can exit. If you're a consumer, you can do some boycotting and things like that. There are many ways of doing making influences, but you don't force the directors to go to one direction. The directors can choose what they want to do, but it will be the market who will be making the assessment. So I think that that approach is more, very market friendly, very in line with what we are what we've learned during the university time, for example, because that's what about the corporate law, and then finance law. The second topic would be more Korean context, which is substantive regulation. So we still need some regulations and laws in terms of having the company to pursue some kind of social value. So one example that I want to talk about Korea is that there's a law called Serious Accident Punishment Act, which sounds a bit scary. And what's it about is that if there's an accident, serious workplace accident, like for example during constructions or things like that, and some workers have some personal damages, things like that, and sometimes the CEO or the top executive could be even criminally liable. So before that, they were only civil litigation. So which means that if you are the CEO, you measure what is the cost of maybe losing that money versus the benefit that they can have it by, having less safety measures and things like that. But now it's a criminal liability, which means that you cannot compare with the benefit because it's your personal risk. So I feel like the CEOs of the Korean companies are really, really anxious about the new regulations. Of course, there are some pushbacks from the industry association and things like that, but it has some impact. So my second point would be that the regulation still have something to do in terms of social impact. My last point is very, very Korean. And if you have a Korean friend who do investment in Korean stock, just ask them to buy your lunch or dinner or something like that. The reason being is that our Korean stock market has been the most successful market in the world. Our KOSPI index is something similar to S&P or something like that, has almost doubled in 2025. So it used to be around 2,500, but nowadays the index is almost 6,000. So it more than doubled. But for your information, I am prohibited of doing investment in Korean stock. The reason being that I'm currently serving as a non-standing commissioner at the Securities and Futures Commission. So I have some conflicts, so I feel really bad because I've been emphasizing that you need more investor protection, but I'm not personally benefiting that, but I'm really happy. And why that change happened is that around 40% of Korean adults are investing in listed shares. So the politicians are really, really interested in making investor-friendly legislation to please their voters. So for example, now we have, last year we have amended our corporate law saying that directors has a duty to its shareholders, not only the company, but also to the shareholders, which give a very, very strong message that the politicians are taking care of the shareholder value. So speaking of shareholder value, sounds like very controlling to social impact topic that we are having now. But if you have like 40% of Koreans happy, like it's a social impact, right? So that may sound a little bit counterintuitive, but in Korea, like pursuing shareholderism value has some kind of like stakeholderism result, which is very, very interesting. So let me stop here. Thank you.
Briefly talk about how Japan has coped with stakeholder interest and some factors behind it. In the post-war Japan, the first major move toward protecting stakeholder interest was fight against massive pollution that occurred during 1950s to 1970s. Firms initially reacted very slowly, but the government stepped in during 1960s and 70s, and it eventually became standard practice for at least large firms to make investment in pollution reduction. In the 1980s, a different movement emerged. Firms made massive donations and investment in the field of culture, and this was called fund mecenat, borrowing the French word. However, the Japanese economy lost momentum in the late 1990s, so did the fund mecenat, so it eroded. So it was like a way for spending their abundant free cash at that time, which means might be a kind of a waste, but as we know, waste sometimes grew culture. So most recently, a large number of Japanese listed firms supported TCFD, which has since been dissolved. On business and human rights issue, I'm not sure most Japanese firms are actively engaged in that, but at least Japanese regulators are eager to make listed firms more disclosure through their annual reports. And another relatively new trend is that firms are rapidly trying to improve working conditions, largely driven by labor shortages and government recommendation. One notable feature of Japan is that most of these trends have unfolded outside of corporate law. Some are relevant to securities regulation, but corporate law is outside of this kind of trends. So the recent developments are interesting in this sense. The Corporate Governance Code provides that addressing sustainability issue, including climate changes, is one of the board's basic duties. However, the Corporate Governance Code does not directly state that protecting stakeholder interest per se is a board's responsibility. Instead, it frames stakeholder contribution as necessary for mid and long-term corporate value without defining what the corporate value is or clarifying its relationship to shareholder value. The draft of revised corporate governance code does refer to appropriate distribution to stakeholders for the first time in the history, but the overall picture seems largely unchanged. One reason behind the Japanese government reaction, which is not direct, it might be a fear of being seen as rolling back efforts to pursue shareholder interests. As we know, some foreign investors and perhaps some foreign governments believe Japanese firms were dominated by employee interests through 1990s or early 2000s. I'm not sure this is a fair characterization of that era, and I don't think most people expect a return to that era. But business leaders frequently invoke stakeholder interests as a counterweight to shareholder value. So it's understandable that Japanese regulators have been very cautious and deliberate when it comes to addressing stakeholder interest in the context of corporate governance. Thank you very much.
Thank you. Thank you, Professor Manabu. And for the last one, but not the least one, please, Virginia. Virginia will talk about the climate change disclosure.
Yeah. Hello. I think this is working. Thank you so much, and really a great pleasure to be on this panel today. So our topic again is on social, the role of corporations in promoting social good and social impact. And there are some things that in the Hong Kong context where I work we could talk about. We could talk about social entrepreneurship. We could talk about issues around even waste management and how to move forward as a society in a very urban setting in that regard. I want to talk a little bit about some of the efforts that we've already mentioned today in the area of regulation for listed companies and what is kind of the trickle-down effect on the largest companies, but then potentially on the rest of the market. And if we think about the SDGs, climate SDG 13 and the nature and biodiversity SDG 15 are not unrelated to the other SDGs, including the societal-facing ones. If we think about climate as directly impacting on all of us, issues of equity, a just transition, these are all interrelated. And so, even though I'm going to be talking about climate, I think there's direct societal impact and even workforce or innovation or development-related impacts that we could talk about. And so just wanted to really briefly kind of give you all like the first preview of a report that's coming out shortly in the next month or two by the Corporate Governance Institute of Hong Kong, the Climate Governance Initiative of Hong Kong, which is under the Hong Kong Institute of Directors and is part of the Chapter Zero Alliance. Some of you may be familiar with that kind of newer name for the Climate Governance Initiative. But in any event, the question that prompted it is, what might be the effect of some of these capital market disclosure rules that we've been talking about, the ISSB rules in particular, on what boards are actually doing, and in particular, what are directors actually thinking about strategy and how their organization needs to adapt. And the broader question then of what will the largest companies be as leaders in climate adaptation and climate resilience, which I think again brings us all back around to questions of our society as a whole. So we were curious about this, and so last year the Climate Governance Initiative in Hong Kong instituted kind of a pilot survey. It's the first survey, it might be biannual, we'll see what happens, but surveyed about 100 sitting directors of listed companies, as well as executive officers, as well as subset of people involved in sustainability and corporate governance advisory on the question of corporate climate governance and also awareness and action in the area of nature and biodiversity, which is not yet covered strictly or narrowly under the Hong Kong listed company standards under ISSB, but it's kind of at the forefront. Some of you may be familiar with the TNFD or the Task Force on Nature related financial disclosures, and it's kind of looking at what are some measures by which we might look at nature and biodiversity resource dependencies, but also impacts. So it's not kind of part of the framework that Hong Kong has yet adopted, but as we've talked about here on the panel, many of our jurisdictions in Asia have already adopted kind of regulatory approaches to get information out to the market about climate disclosures and impacts. And then as early as 2024, so Hong Kong was one of the early leaders in adoption there, but in 2024, the Hong Kong Stock Exchange had already revised its corporate governance code to require all directors of listed firms to undertake mandatory ESG and climate-related training on an annual basis, and so that took effect last year. So again, that was kind of the backdrop for this survey, but we also did some working groups, and so we had, again, a kind of small pilot, about 100 respondents on the survey, kind of across the director space, but also executives and sustainability advisory, but then we also had about 30 to 40 participants in kind of 3 separate working groups or roundtable discussions that I was involved in last summer, and they were very fascinating, really, really interesting. So I just want to share like a little bit of feedback from that and what we learned about where companies actually are in becoming resilient, in thinking about transition risk, and hopefully these largest companies ultimately then leading the market and the community. So there's good news and bad news, as you might expect. I'll start with some of the bad news. The barriers are that a lot of companies and a lot of our respondents reported being kind of overwhelmed with short-term pressures that are preventing them from thinking in a long-term manner, even though there is a kind of self-selection bias in our survey and in our working groups of those that are actually already thinking about climate, otherwise they wouldn't show up to participate. So, these are already kind of those who are perhaps more long-term thinking. The other thing is that there appears to be a weak, even for those, again, that are aware of climate risks, climate issues, the need for resilience, they're seeing in their organizations a weak integration of these issues into strategy at the board level. And in discussions around sustainability issues, there's kind of maturity in the market when thinking about disclosure practices. So compliance with these disclosure norms and standards is maturing. But in terms of actually changing, how does the organization see its long-term strategy? How is it operating? That's a little bit different. And again, a common complaint as well is that it's hard to get reliable data because it is so early. And crucially for those of us here in Asia, one comment I thought was interesting that comes out of the survey and discussions is that it's not just data problems, but how do we get data that's localized to our local regional context? What is the state of reliable climate and nature, biodiversity data here in Asia, in the region? And so I thought that was interesting. What we can say on the positive perspective is about over 75% of our participants see climate as a business opportunity. So we saw that as a positive. It's not only on the risk side, but also as an opportunity. And that around 68% of our sample viewed the board, would report that either the board they sit on or the board that they advise or serve views climate as a priority, even despite the pushback, even despite the anti-ESG moment, even despite geopolitics, all of that climate is still a priority. And that 75% again of our respondents report that their board does influence corporate decision-making on climate. And another good final data point is that almost 50%, again, we have somewhat of a self-selected sample, admittedly, about 50% of those participating report that their organization has adopted a climate transition plan, which I thought was high, again, even for a self-selected bunch. And I was encouraged by that also when I read a report that the Hong Kong Stock Exchange put out in December, which was looking at all listed company reporting, and I have some kind of helpful data points there as well, which is that last year, which is again the first year of mandatory reporting in Hong Kong, 84% of large cap firms were monitoring climate resilience using some kind of scenario analysis. So if our question is, what is the effect of these regulations on what companies are actually doing, it is pushing many companies, at least the largest ones, to at least be thinking about resilience and thinking about climate transition, which I think can have broad impacts for our societies. For us in Hong Kong, again, listed companies are from around the region. A lot of them are mainland companies listed in the capital markets in Hong Kong, so that can have kind of a broader trickle-down effect. Unfortunately, if you looked across, not just the large cap, but across the market as a whole, only about 15% of the entire 2,000 plus companies listed on the Hong Kong Stock Exchange are adopting scenario analysis and measuring resilience. So there's work to be done, but there is a start there. And in the working groups that were kind of the background for this survey and this report, one thing that we found is that there is a synergy in collaboration. We talked a lot about collaboration today, and whether that's collaboration between government and the private sector, whether that's collaboration between companies and civil society, NGOs, their stakeholders, all of those collaborations matter to boards and matter to leaders in thinking about how climate affects strategy, not just disclosure, not just compliance, but is it really affecting our forward-thinking ability and our focus and the extent to which we are able or do feel motivated to look more long-term. So I think this is a little snapshot. We don't think it's like the end of the story. I'm sure there'll be more data coming out about this. But that's a little bit of a snapshot as to how the largest companies and even listed company regulation that we've talked about in many of our markets may be making an early impact, even though, again, there's a long way yet to go. And we hope that that will spill over into kind of looking at some of these frontier issues around nature and biodiversity as well that are not really on the radar screen yet in Hong Kong, I will say, but at least there's greater awareness of the need to look at those connections, because you can't be looking at climate risk and resilience without looking at nature and biodiversity and resource dependencies. And I think we're all very mindful of that in the current moment with everything that's going on in the world as well. So I think I'll stop there, but that's some early insights.